Clear that South Africans are fairly vulnerable at this stage, and especially if you compare this to the situation as it was in 2010. A lot of South Africans, maybe because of the soccer, were very upbeat, felt that the economy is picking up, they're going to get jobs, etc. And a lot of them have found out in the meantime, well, the economy is not picking up so consistently as they thought. There's a lot of job losses going on. People who are jobless are struggling to get jobs, so they're really becoming more vulnerable.
With regards to spending and debt servicing capabilities, household debt to disposable income is still very high. We're sitting at around 78%. How are we faring on that front?
It's very clear when we look at national credit regulator statistics at the moment that about 47% of all credit active consumers are in arrears for 3 months or more, or being blacklisted. So that's a real indication. Another one is that for people who need credit to survive, the lending criteria of your formal sector financial institutions have been increased to such an extent that they're really struggling to get credit, while a lot of your poorer people that need to live off credit can access the so-called payday lenders. But what is very clear from that is when you look at your credit extension statistics last year, is that you find, for example, in the fourth quarter, that while there was very little growth in credit extension by formal sector financial institutions, your unsecured debt grew by 16% in a single quarter. So that's a clear indication that a lot of people are still taking debt, but it's more unsecured debt.
With regards to income, how vulnerable are South Africans feeling? Of course, we've got unemployment at very high levels. We've got a lot of people excluded out of the employment sector because of skill shortages.
Actually not, because it depends also on which sector of the population that you're actually focusing on. We find, for example, that the skilled proportion of the population are actually finding it much easier to obtain jobs because their skills are in high demand, and also of your affluent, more than 50% of them are formal sector entrepreneurs creating their own jobs, etc. However, on the other side of the coin, you find, for example, that your people who are currently jobless, who are fairly unskilled, that their chances of actually obtaining jobs are declining. And the simple reason for that is that employers are taking on more skilled people, they need more skilled people, while they're replacing a lot of their current low-skilled labourers with capital.
Interest rates are currently sitting at 30-year lows. With regards to savings, we know that when you've got a repo rate of 5.5%, there's no real incentive to save, but of course more of an incentive to spend.
I don't think so, because a lot of consumers at the moment indicated to us that they're not saving quite a lot. Quite a lot of your consumers, however, did not view that as a crisis, the fact that they haven't got a lot in terms of savings, etc. What they did, however, indicate is that in terms of emergencies, they found, for example, that it's very important to have savings to draw on. However, in this regard, your levels of financial literacy of consumers are generally not sufficient high to make them realize the importance of saving more, for example, and actually to have a type of culture where they would first save and then buy luxury goods, etc. We've got a culture in South Africa where when you want a lot of luxury goods, etc., that you will take the credit, that you will pay incredibly expensive over the longer term for those products.
The repo rate is sitting at 5.5%. If the forward rate agreement market is pricing in a rate cut, do you think that it is warranted right now and it is going to assist the consumer to prop up spending?
Well, I think when you look at the economic growth rates in South Africa, to a very large extent, namely 62% of your GDP consists of household consumption expenditure. So on the one hand, you want people to spend because we need a much higher level of growth, especially with the fairly bad state of your international markets and also consumer markets, we're not really going to have a lot of exports there, etc. Now the question is that should the interest rate be cut, for example, to stimulate consumer spending more? Not at this stage. But by June this year, it would have been very, very wise to have dropped the repo rate, because that would have been a stimulatory effect for the rest of the economy.
So you're saying we should have actually already cut rates?
We should have done that,
by 50 basis points.
By 50 basis points
and
in
now
June.
It's too late.
Well, at the moment, it's just that we're moving to a situation of stagflation. Stagflation in the sense that currently we've got very low levels of economic growth, and as you've seen, we were barely positive in the second quarter. When you look, for example, at your inflation, it's picking up. So you've got much higher inflation, etc. And now you're sitting with a situation that should you do a rate cut now, for example, a lot of consumers will start spending more. It might have a small impact on your GDP growth, simply because a lot of the consumption goods that consumers buy will be from overseas, not having that impact on South Africa, while that increase in demand will have huge inflationary pressures.
Looking at the way that inflation is measured, we know that on a global level it's starting to be viewed in different light. With regards to stagflation, we are expecting around 3% growth this year. We've got an inflation rate that is very close to reaching the target band of 6%. How do you quantify stagflation? What kind of levels can we expect on growth and inflation?
Okay, there's not a formal definition, but the rule of thumb here is basically when your inflation rate is twice as high as your growth rate. So we're sitting here at the moment at the possible growth rate. Our current forecast is about 2.9% economic growth for 2011, and you will have an inflation rate of about 5.8, which is very nicely about double that, etc. Typically an indication of stagflation.